Good day. In this presentation we'll look at the three different scenarios discussed in the brief. We'll check the financial feasibility of renting out an apartment for 5 years, renting it out on a short-term basis on a platform such as Airbnb, or selling it and investing the money in unit trusts. In the first scenario, we'll have two different columns where we look at the value of the house. Okay, the reason for the two different columns is due to the 35,000 Rand, which increases the rent of the house by 800 Rand, but also increases the value of the house. Okay, so the value of the house was determined by working the 920,000 back to the 720,000 in 2014, and that gives us a increase of 6.3% per year compounded annually. These black lines represent the entire tax year, which starts in March this year and ends on February the following year. The property agent takes 8% of the monthly rental income. Due to the 35,000 Rand over here for laminating the floor increasing the monthly rental income, it also increases the property agent cost. Therefore, there are two columns. Orange represents not laminating the floor, and blue, which represents laminating the floor. These principles are followed throughout this entire scenario. As you can see here, this over here is the total cost for the agent over the tax year. Then we have the different costs associated with renovating and repairing the apartment. Then we have the maintenance cost for the year, which is 1% of the value of the house. This again is influenced by the 35,000 Rand for laminated floors. All these costs and incomes are calculated in a tax year. Right, that's the total cost for the year. All of these expenses are tax deductible. We'll come back to that later. Then we have levies, which was increased by a monthly interest rate of 8.3% and 7.9% respectively, determined over the past 4 years. These periods are not fixed periods, the periods over which they increase. So the safest bet was to increase it over a monthly period, average monthly period, up until the end of each financial year, and then the sum total is over there. Then we have our rental income with a 4.8% increase, which was it's just the average increase over the last 4 years. The assumption is made that the same person stays in the apartment for the entire 5-year period, so we can't increase the rent of the apartment by 8% per year. After we have our rental income, we can calculate our total income for the year, which is the income our owner receives from work plus the income she receives as rent. From our total income for the year, we can determine our taxable income, which is the total income minus all the tax deductible expenses. We then use the taxable income to put ourselves in a tax bracket and determine the tax for the year. The tax for the year over here is then deducted from our total income for the year, which leaves us with a total income after tax. From this amount, all the expenses are deducted. To finance our renovations and maintenance, we can either refinance, use our credit card, or take out our personal loan. For refinancing our mortgage for 10% prime interest plus 0.75%, we get an 8.95% interest per month. This is calculated by taking the 10.75 and dividing by 12. These principles apply to both the credit card and the personal loan. Then we have our annuities, and the annuities add up to a total loss over the financial year, as you can see here. Then this column on the right over here is if we decide not to refinance our mortgage. In other words, our total losses when you refinance is this value over here, and this applies to both non-laminating and laminating the floor. And then for our credit card or loan, we take this value which we would have paid for not refinancing plus our credit card debt for the year. Then we sell our house after 5 years at the value which was determined over here by the 6.39%. After selling our house, we lose from our capital gain by 24.57%. This was just determined by taking the current capital gain tax and increasing it over an average for the last 4 years. Finally, we lose 7.5% from our capital gain for property agent commission. This was determined through research. This value over here is our final capital gain for the house, plus our income for the 5 years, which we determined here, minus our losses due to refinancing. And this is the final value we get over here, our net profits. The principles relating to income tax and financing used in the first scenario apply to the two other scenarios. Now we'll start with the second scenario, which is renting over a short-term period. When we rent out over a short-term period, we'll need to pay a domestic worker to clean the house at a minimum wage of 2.65%, which increases at a CPI of 4.9%. Then we'll have our extra tax deductible expense over here for furnishing, 50,000 Rand, and all the other principles remain the same. Over here we have our rental income as determined by the MBOB website. The estimated potential, a monthly potential earnings of 6,315 for 50% occupancy minus the 3% service rate. So the 3% service rate is already deducted. We start then with the short-term rentals in January 2019, and they increase by the same CPI of 4.9%. The same principles apply to the Lapslop income. And then we'll sell the house again under the same principles as used earlier. Alright, and this would be our final net profit. If we choose to sell the house immediately, we'll still have to deduct 10,000 Rand for repairs and renovations. Then from our capital gain of selling the house, we'll need to deduct 18%, which is the current capital gain tax. We'll also need to deduct 7.5% of the selling price of the house for the property agent. Then we'll invest in 3 different funds, each of these outlined here. The left hand side of each of these columns represents the capital of the money we invest, and the right hand side is the interest that the invested money accrued over the financial year. The reason for this is we need to pay tax on our interest of invested money. Over here we have our annual fees on investment for each of the different funds and our total fee for each financial year. And then using the same principles, we'll have a work income, a total income, which we then use to determine a taxable income, deduct tax, deduct expenses, and then we'll have overall profits for the 5-year period, which is outlined over here. And then we'll also have our capital gains, which is the sum of the capital in each investment after we sell them off in the 2023 tax period. We'll sum them together, and then we'll lose capital gains tax of 24% as outlined in the previous scenario. This altogether give us a net profit over 5 years of 5.21 million. When comparing these scenarios, we'll see that the most lucrative option is to rent out the apartment for a 5-year period, laminate the floors, that includes in the 35,000 Rand cost, and immediately fix the stove. We'll also have to refinance our current mortgage payment over for another 20 years.